Okay, I'm going to start off. My name is Jo Marie Griesgraber. I'm the Executive Director of New Rules for Global Finance, and it's our privilege to co-sponsor this event with the Heinrich Boell Foundation and the FACT Coalition. I don't think there's a description of the FACT Coalition, so let me just give a word on that. It means Financial Accountability and Corporate Transparency. It's a broad group of about 40 organizations working on to change U.S. policy because of its international repercussions. Its agenda includes country-by-country reporting for corporations, the disclosure of beneficial ownership, automatic exchange of information, and a fourth item. We have four main policies, and I have to forget the fourth, no matter where I start. In any event, please check out the FACT Coalition. Nicole Tichon, the Executive Director of Tax Justice Network USA, coordinates the FACT Coalition. For our part, New Rules for Global Finance, there are a few brochures that are available. We promote global justice through the regulation of international financial institutions. We really work for the voice and participation of those excluded from the table. So with that, I'm going to do a brief introduction to all the panelists. At our last panel, I gave way too much detail, so I presume you are intelligent, literate adults and can retain what you read. Maybe that's a false assumption, but in any event. We are especially pleased to have Ms. Leslie Wayne here. Leslie is a longtime journalist with the New York Times. She has, if you read through her bio, she's been on every single important media platform. She's got a phenomenal history of writing, and she now teaches at Columbia and at NYU. So she says, all of a sudden, I'm no longer working full-time for the New York Times, and I'm getting all this attention. Well, that's good. Her work deserves the attention. And she did the story in the New York Times Sunday business section of July 1st on Delaware as a tax haven. And I should say, we did invite the Secretary of State from Delaware, invited that office to attend. They would have come had they we've been able to also secure someone from the American Bar Association and/or from the U.S. Chamber of Commerce. I could not secure a speaker from either of those institutions, so they declined our invitation. The next panelist, as listed on your program, is Rebecca Wilkins. Rebecca Wilkins has long been a CPA operating out of Denver. So we have a journalist and a CPA. I'm a political scientist, and you all know that's an oxymoron. Living in Washington, you know how scientific politics is. She currently works at the Citizens for Tax Justice and the Institute on Taxation and Economic Policy. She was very instrumental in the 2011 Corporate Taxpayers and Corporate Tax Dodgers report. That was just a great read if you really want to get depressed about American businesses and how little they pay in terms of taxes. Rebecca did the research behind that, and she's a very active member of the FACT Coalition. Next on the list here we have Jack Blum. Jack is one of the board members of New Rules for Global Finance. I've known him since I first heard the word tax. He is also on the chair of the board of Tax Justice Network USA, and he has a long time practice in law. And I think for me the most interesting element of his biography is that he was worked on the Senate Foreign Relations Committee. Didn't you do Chile?
Some of that too.
Some Chile, but yeah. He's just done tons of work on the Senate Foreign Relations Committee. And if you want to hear good stories that are based on fact and that will make yourself catch your breath, you won't be able to breathe. You're laughing so hard at human nature. Just get together with Jack. And it's all true. To my immediate right is Ms. Liane Schalatek, also on the Board of New Rules for Global Finance. She is the Deputy Director of the, Associate Director, excuse me, of the Heinrich Boell Foundation for North America. The Heinrich Boell Foundation is the foundation of the Green Party of Germany. And she specializes in finance, and environment and gender, and then the nexus between and among those themes. And she's just a terrific writer, friend, colleague, and board member, and she too has training in journalism. So we have the journalists are on that side, and we have a lawyer and a CPA. So I think we have a very balanced panel. The purpose of these seminars are on critical issues on finance and on financial regulation, and New Rules regards tax as part of the package of policies that, for example, the Financial Stability Board should be looking at and regulating in a systematic way because of their impact on the lives of real people and the real economy. And so we continue to unpack the tax package. I don't want to take your time. I'll have my chance to intervene. We're going to begin with Leslie Wayne, and then we'll have Jack and Rebecca speak, and Liane will wrap it up. Liane will speak about the impact of these kinds of policies on global public goods. We think about the impact on U.S. federal budget and our deficits. We think about what it means to tax earners and to regular U.S. citizens. It has consequences globally, and in the arena or the parameters are much wider than we're normally think of these issues. So with that, I am just so happy to welcome Leslie to Washington, to this panel. She's not new to Washington, but I'm just delighted. She was so easy to work with. I'm just stunned at how accessible she's been. So Leslie, thank you.
Oh, thank you very much. It's terrific to be here. Before we start, I just want to have one sort of commercial interruption before we get into tax havens. One other project that I'm involved in that I want to get a little attention and publicity for is a project called 100 Reporters. And I'm senior editor there, and it's a Ford Foundation funded project that is, we're just getting off the ground looking at global corruption. So check out our website, which is 100r.org. And, Facebook, and friend us and like us and do all those things, because the foundation, likes to see all those little thumbs up things. But anyway, so on to Delaware. I did a story in the Times, a couple of weeks ago. It was the Sunday Business cover, and it was about Delaware. The genesis of the story was I was at a conference overseas that related to money laundering, and somebody mentioned Delaware as this money laundering place. And I said, oh, well, they have this great chancery court, and there's this whole history of law, and it's a very sophisticated place. And the guy looked at me like, are you naive? What planet are you on? So that was kind of the trigger. And I think that when we begin to look at offshore accounts and the offshore accounts, and when we begin to look at the FCPA and all this emphasis on overseas tax havens, the more that the United States looks at these overseas tax havens, the more that the mirror comes back to the U.S. And when the mirror comes back to the U.S., the most prominent case and the most prominent state to look at is Delaware. And we'll start the story of Delaware with 1209 North Orange Street. If you remember that President Obama famously talked about the Ugland House in the Cayman Islands, where there were 120 corporations registered there. And he said it either has to be the largest corporate headquarters or it's got to be the biggest tax scam. Well, get on the train and go about 100 miles north of here, go to 1201 North Orange, and you will see that there's 285,000 corporations that are registered there. Now, these corporations, 285,000. And there's another one at 2711 Centerville Street, where actually the New York Times has some of its subsidiaries registered, that has a similar number. And these are the creme de la creme of corporate America. You've got Apple, you've got Google, you've got Ford, Berkshire Hathaway. You know, all these corporations are registered there. But in with the good comes other people. And, you know, it's people like the Madoff of the Midwest, Timothy Durham, who just got convicted of scamming about $200 million out of elderly people in the Midwest through a Ponzi scheme. You've had, you know, some Serbian cigarette and drug lord who is registered at 1209 North Orange. Other Delaware corporations, we've seen Victor Boot, the merchant of death who was just convicted, had a Delaware corporation. Jack Abramoff had a Delaware corporation. And there are a whole number of sort of Eastern European people who are involved in all kinds of scams who use Delaware corporations. You know, they use the Delaware corporations to launder money, to register their planes, to set up shell corporations, and to enjoy the privacy and the secrecy that a Delaware corporation allows for. And there's another thing which is also called the Delaware loophole. And the Delaware loophole is basically a way in which corporations can lower their taxes in the state in which they do business by incorporating certain subsidiaries in Delaware as well. So if you look at Delaware, you've got more corporations in Delaware than you've got people. You've got 945,000 corporations. You've got 897,000 people. Nearly half of all public companies are registered in Delaware. You do have a sophisticated court system there. That's absolutely very true. That's very pro-business. It's sophisticated. It's non-juried. But Delaware is open for business, and it says so. 1/4 of the state budget, about $860 million annually, is put in through. Is accounted for by corporate and franchise taxes that relate to all this activity. Delaware officials go around the globe promoting Delaware as a place to do business. The Secretary of State's office is open till midnight to start corporations. You can register a corporation, no questions asked, in less than an hour. So you have, fewer restraints in Delaware than you do in the Cayman Islands. And you also have the other attraction of a Delaware corporation is that once a person sets up a Delaware corporation, it doesn't have the same stigma as the Caymans or the Isle of Man or other places. You can then open a bank account anywhere in the world to do business. I think we'll get into discussion about this afterwards, and we can get into more details, but I will hand over the time to my fellow panelists.
Thank you so much, Leslie. That's just sort of like a little tease. So the panelists have been asked to give brief comments so that we have time to talk and ask questions and get all riled up. Jack?
Well, all of that having been said, the other huge problem is that IRS doesn't keep track of those Delaware entities, because IRS has this very peculiar idea that there is something called a pass-through entity. And if you've got a pass-through entity, it doesn't have to file a tax return, doesn't have to get a tax ID number. It goes under the tax return of the person who owns the corporation. What this, of course, means is there's no way of telling who filed a tax return, who didn't, who's taken care of the corporation. And IRS, I've discovered to my amazement, has no way of matching returns filed with corporate names to find out if a Delaware LLC that is a pass-through actually showed up on somebody's tax return. So this is a system where you suddenly can disappear. Also, making this point about the foreigners who are using it for nefarious purposes, if you go to the Delaware Federal District Court and look at the miscellaneous docket you can find all of the requests for mutual legal assistance from different countries around the world asking for help in figuring out who's behind a Delaware corporation to get the records of the corporation because there's a criminal matter that they need help with. Well, the stack is huge and the help is zero. Because what happens is an assistant U.S. attorney in Delaware comes in, files a petition that says, we've been asked to give help. Your Honor, would you please grant us the right to give that help? The judge, of course, does, and that's the end of the matter because there's no information in Delaware. And then there's the bizarre proposition in the anti-money laundering system, equally crazy, that it's perfectly all right to open an account for a corporation because the beneficial owner of the corporation is the corporation. That piece of genius is the genius of IRS in its rules and regulations, and bizarrely, the regulations themselves, which say this, don't match the instructions on the various forms that have to be filed with respect to the corporation. Now, I'll make one final brief point. Corporations were creatures of the state. They always have been. And for the longest time, corporations couldn't operate outside the borders of the state. They were limited to the single state. Delaware pushed through that one. But also, for a very long time, there was disclosed ownership and there was stated capital. And the idea of the stated capital was when you were dealing with this entity, you at least knew that whoever owned it had put some money into it. Well, under the Delaware rules, none of the above apply. You don't have to put anything in. It's just absolutely remarkable. Total anonymity, no traceability, no ability of law enforcement to help. This is never what corporations were designed to do. The whole purpose of the corporation was to limit liability, not to create an anonymous blind so the cops can't trace you. With that, I'll stop.
Wow. Rebecca, I've never had a panel talk so briefly. Great.
What is a tax haven? Well, traditionally we thought of a tax haven as having one or more of three characteristics. One is that they have a low or zero tax rate. One is that they have bank secrecy laws. And the third one is that they have a history of non-cooperation with tax authorities of other countries. So does Delaware fit that definition? And the answer is a resounding yes. They have a low corporate tax rate. There are lots of types of corporation income that's not taxable in Delaware. They have not secrecy rules, but as Jack pointed out, they don't collect the information that you would want. So while they pretend to cooperate, when you ask them for who owns this corporation, they say, we don't know. So we don't collect that kind of information when somebody opens a corporation. We don't require it. So instead, but I do like, if you've seen Nick Shaxson's book, Nick's the journalist who wrote the brilliant Vanity Fair article about Romney's offshore tax investments, and it has a great quote by Jack that Romney just doesn't realize that to the rest of the world, this stuff is just weird. But Nick wrote a book last year called Treasure Islands that's about tax havens. And he doesn't use that traditional definition of a tax haven. He says that a tax haven is a jurisdiction that tries to attract business by creating a stable financial and economic system and environment where it makes it easy for people to avoid the rules and regulations that would apply to them in their home jurisdiction. So it makes it easy for them to avoid the rules and regulations that would apply to them onshore. And so that's, what we see, the hoopla about Romney's Bermuda Corporation, for example. You know, the question that people need to be asking is not just what was this corporation, what was it used for, but why was it in Bermuda? Whatever it was doing, why couldn't it have been a U.S. corporation? And the answer is to avoid some rule or regulation that would apply to it if it was in the U.S. And the U.S. operates as a tax haven for folks of other countries that want to either evade tax and or do some other kinds of criminal activities. And Delaware also acts as a tax haven for companies doing business in the U.S. to help them avoid taxes that they would pay in other states. There was a great article about a year ago by David K. Johnston showing that the S.C. Johnson Company, which is headquartered in Wisconsin, had not paid Wisconsin taxes for over 10 years. And the primary reason for that is they had set up some Delaware subsidiaries, put a bunch of cash in it, had the Delaware subsidiary loan the cash back to the parent. The parent company's paying huge interest payments on these loans that were wiping out their Wisconsin income. So U.S. companies are using Delaware as a tax haven to avoid state-level corporate taxes, the same way they're using Cayman Islands subsidiaries or Bermuda subsidiaries to avoid paying federal-level tax.
I don't know about you, but I've got about 150 questions lined up. But before we go to specifics, I'd like to invite Liane to speak and we've been looking very closely at the United States, the Caribbean, Treasure Islands, but let's look now and put this in the global context. Liane?
Yeah, thanks so much. And I have to admit that I'm not a tax expert, but I'm dealing with global financing issues, and it's through that lens that I'm actually looking at the question how tax dodging in the U.S. affects the role and the contribution of the U.S. For financing for global sustainable development. We obviously all know that there is a lot of money needed for the realization of the Millennium Development Goals, and also to support global public goods, for example, preservation of biodiversity or combating climate change. And we also know that whatever is offered so far is way below what is needed. We had kind of a reminder of this discourse just very recently in Rio at the UN Conference on Sustainable Development, so-called Rio +20, which did affirm, for example, the commitments of developed countries for overseas development assistance, but did not come up with any concrete mandatory financing scheme or actually ideas of how that financing for sustainable development could be created. And while there was, for example, recording of voluntary commitments, mostly actually not by governments, but by private sector and civil society, for example, the only concrete US government financial pledge given in the context of Rio +20 were a meager 20 million for clean energy projects in Africa. And that, again, comes from the country that is globally the largest economy and also historically the largest emitter of greenhouse gas emissions. Now, what is the role of tax revenue for sustainable development and economic growth? It's obviously a key element of development for impoverished countries. They need the tax payment from businesses as part of their domestic income. It's part of or prerequisite for a functioning state. The ability to collect taxes effectively is also a constituent element of accountability between the state and the citizen, and I would stipulate it's a fundament of democracy. And actually that reflects very badly on developed countries who usually hold out bad governance in developing countries when they kind of fulfill to uphold that part of the social contract. Also, the current dependence of many developing countries on ODA, on overseas development assistance, is of course not sustainable. It's very unpredictable. You have short-term flows which prevent long-term planning and often toward the preferences that recipient countries have for how you want to use that money. Tax dodging, and dodging is obviously both the tax evasion through a legal means, but also the tax avoidance by, for example, mispriced transfer pricing hurts developing countries. And it hurts it in two, I think, very important ways. First, by depriving developing countries of domestic tax revenues and weakening their domestic tax base. Second, by withholding tax revenues from developed countries, thus undermining, for example, OECD's countries' ability to fulfill their legal and moral financing obligations toward developing countries. Overseas development assistance is one part, but climate finance, for example, is another, and I can go that, hopefully, if I have the time, a little bit into detail, or we go into it during the question. But it also towards the ability of developed countries to fulfill the responsibility towards their own citizens, for example, by providing adequate public services. Christian Aid, an NGO, has estimated that per year about 160 billion of denied tax income to developing countries are basically not given to those developing countries by multinational corporations using tax havens. And the estimate of the Tax Justice Network is even higher. They estimate that developing countries might lose $10 in tax income through tax dodging for every $1 they receive in overseas development assistance. And then when you look at what the current overseas development assistance levels are, you are kind of stuck at a 133 billion per year, with the delivery gap, meaning how much you actually would need in additional order in order for developed countries, OECD countries, to fulfill their 0.7% of GNI cross-national income pledge, being 167 billion. The US fares pretty badly in that context. Also, it's the largest single country contributor with around 30 billion ODA in 2011. If you look at it as a percentage of the cross-national income, it's 0.2%, and only a couple of countries, including Greece and Italy, which are obviously faced with a number of problems right now, actually spent less on ODA. So what would help actually? Closing the tax loopholes for multinational corporations. You would need a global approach to corporate taxation. And I think it's important because multinational corporations are obviously not just the American ones, but very much the American ones, and others are the winners of globalization. And tax havens are at the heart of how they profit from the globalized economy. When I prepared for the discussion, I found indications that about 60% of world trade is within multinational corporations, and more than half of world trade passes through tax havens. So it's very, very relevant to the discourse about globalization and the role of multinational corporations in that. So multinational corporations should contribute their fair share of taxes, and a significant portion of this should be devoted to global public goods, sustainable development, and fulfilling basic human rights and needs. And I'm not an expert on that. Maybe our tax experts can get into that in the discussion. In the US, there is a legislative effort going on, the so-called Cut Unjustified Tax Loopholes Act proposal by Senators Levin and Conrad that could result in 155 billion in revenue over 10 years by closing US tax loopholes for US corporations. Now, I wanted to really briefly just take a closer look at climate financing, because it's obviously an area where I work a lot with, but I think it's also very relevant about the discussion of taxes or the applicability of taxes and closing of tax loopholes to the financing of a global public good like the stemming of dramatic climate change. Obviously, developing countries face daunting financial costs to deal with climate change, and it's growing because of political inaction. The longer we wait, the more expensive it's going to become. And as I mentioned earlier, through the UN framework on Framework Convention on Climate Change, developed countries, including the US as the largest historic emitter of greenhouse gases, have a legal obligation to actually provide the financing or help provide the financing that developing countries need to deal with climate climate. The sums are very high, for adaptation. Some estimates go up to additional 100 billion per year needed by 2020. That comes from the World Bank World Development Report on climate change and development. Likewise, for mitigation, there are numbers as high as an additional 175 billion per year to deal with that. And obviously, what is provided or has been provided so far through dedicated climate financing instrument has been very paltry. Again, developed countries have taken on responsibilities and political commitment to provide climate change financing, both in short term, which is supposed to be new and additional to what they have committed on spending on overseas development assistance, but also long term. And short term, they have committed to raising jointly 30 billion over 3 years from 2010 to 2012, with long-term commitments of up to 100 billion per year by 2020. I know it's a lot of numbers. I have a PowerPoint, so you're welcome to look into that in a little bit more detail. But what is the reality, actually? And again, I'm looking at the contribution of the United States. Looking at Fast Start Finance, the United States over the past 2 years, fiscal years 2010 and 2011, has contributed 5.1 billion, and that sounds on the surface relatively good, but it includes ODA, Overseas Development Assistance. Again, the money was supposed to be new and additional. It includes loans, loan guarantee, and insurance, and provides only a third of the money in terms of grants. And of that, only 16% of adaptation, where you actually, in terms of moral responsibility, really have the biggest political demand to act very fast. Climate relevant, and I think that's also very important, and I gleaned some of that information actually, Leslie, from your wonderful article. I think the question is also the role of extractive industries in tax dodging. For example, Publish What You Pay Norway has done a report according to which the 10 most powerful extractive industries corporations operate with 6,000 subsidiaries globally, 2,000 of them in secrecy jurisdictions. And obviously what happens then is that the value creation from extractive industry that should benefit the people, the poorest people in those countries from where those the resources are extracted, don't get the benefit of it. And I think that is actually a very little talked facet of the larger discourse about the resource curse. Tax avoidance via transfer pricing is also a very common problem in extractive industries. Again, the Publish What You Pay Norway report, in a different report, reported about disappeared 110 billion between 2000 and 2010 in over and underpricing of import of crude oil into the EU and US. Delaware, as a location for multinational corporation subsidiaries dealing with global energy and mining, is also a very, very important spot among the 10 top companies. More than 900 subsidiaries of those companies are actually registered in Delaware. And in comparison, in Switzerland or the Cayman Islands, there are 50 And again, thank you, Leslie, for bringing that out in your article. And then I think closer here to the US, and that's one of the last points that I wanted to make. 400 corporate subsidiaries, which are linked to the Marcellus shale gas exploration in Pennsylvania, the neighboring state of Delaware, are also registered in Delaware. And so the Delaware loophole deprives the neighbor state of income, which is obviously very crucial to dealing with both the environmental and social costs of the shale gas exploration, of which there are many, as we now start to realize. Lastly, and just 2 more sentences on that, the importance and the role of taxes for new climate and development finance. The UN-DESA World Economic and Social Survey report, the most recent report, says that new taxes are at the heart of helping, quote unquote, donor countries overcome their record of broken promises. And there I think the role of the US is kind of doubly hindrance. Not only does it not contain tax dodging in US jurisdictions as well as abroad, including by US corporations, but it also blocks all international efforts, for example, to introduce a currency transaction transaction tax or a financial transaction tax, which could be one of those tax efforts to raise money for global public goods. I guess I'll leave it at that, and hopefully we'll have more opportunity to go into detail.
Thank you.